The right-hand chart is showing you all the different ways that you measure speculative activity. They're all in the 98th percentile for penny stocks, 85th percentile for unprofitable stocks. The left-hand chart's really interesting. Here, this shows you that forward returns on the 3, 6, and 12-month basis are actually better for the broader market when you are seeing this speculative fervor. That makes sense. You don't see speculative fervor in a bear market. But what's interesting is that once you get past into the 24-month and the 36-month, forward returns drop precipitously and are actually far, far worse than if you didn't have this speculative boom. Which is just to say is that it's almost a pull forward of good returns that happens in times like this. Very similar to what we saw in 2020, 2021. Everything was awesome. Everything was rallying. And then, of course, we had an experience like 2022. So something to keep in mind as we think about sticking to our knitting, sticking to quality, it's not just for the sake of not being whipsawed by the overall returns of these lower quality names, but to note that the market itself tends to do poorly looking out 2 years from times just like this.